Hi, this is Jen Rubin, editor-in-chief of The Contrarian. Delighted to have back Professor Justin Wolfers from the University of Michigan. Welcome.
Hey Jen, how are you, mate?
I'm just fine. I'm just fine. I hope the kids are back on campus now and another school year has begun. Um, Last week, the chairman of the Federal Reserve went to Jackson Hole, and it's kind of bizarre that the entire world now looks to Wyoming for a speech that the Federal Reserve gives every summer at a shindig with a bunch of wealthy business people and economic people. That is the world in which we live. What did he say or not say, and what do you take from that?
Jen, I have to defend Jay Powell here a little bit, which is actually wealthy businessmen do not go. It's
Oh,
all
okay.
nerds, 100% nerds. It's central
All
bankers.
right, very good.
I went a couple of years ago. It's quite beautiful. But yes, there's a big annual set piece speech as part of the conference. But it's central bankers around the world having a very healthy talk. It's terrific. And I think there's a little bit of dancing too. That's kept off camera. I probably shouldn't even tell you about it, but there you
Take
go.
it,
Um,
Mount, the chairman, uh, lighting up the Downsfield. But go ahead, yes.
yes. Okay, so now let's talk about economics. Chairman Powell basically updated the world on his thinking. And his thinking is he had been, let me start with what we had thought so then we can get the update, which is basically Trump came to power promising robust tariffs. Tariffs could slow the economy, which normally would cause the Fed to lower interest rates. Tariffs could raise inflation, which normally would cause the Fed to raise interest rates. And so I think Powell basically engaged in a game of you go first. Mr. President, you set your agenda and then, which is a long run agenda. And then I will balance the ups and downs of the business cycle once we know what it is you're doing, which I think was a very smart thing to do and very much the right thing to do in February, March, April, when trade policy was up in the air. Now, the problem is, Liberation Day was April, then we went on a 90-day pause, then we added a 24-day extension. We actually now officially have the tariffs, we feel liberated, but the president hasn't given up using the word tariff. He's continued to change policies and the ups and downs. He added an extra 25% to India because they bought gas from Russia. He's talking about new tariffs all the time. And so the idea that at some point the president would have set his policy and then the Fed could respond, I think ultimately we learn this is not how this White House works. And so the idea that uncertainty will be resolved and then the Fed will respond, let's find out the environment and then respond to that environment, we've learned is just unsustainable. So to me, that's a political judgment, not an economic judgment. Or alternatively phrased, you could say that the call for action got stronger. So the president had been leaning very heavily on the Fed to cut interest rates to actually quite absurd levels. And so the Fed, in order to exert its independence, had stood up against that. And that's where we were leading into Jackson Hole. One more reality, which is last time we spoke, Jen, in fact, people had been saying the economic headlines are so bad, but the reality is not. What's going on? Then we got a little more data and we got some revised data. We went back and got more information about what had happened in the first few months of the Trump presidency. And all of a sudden that optimism disappeared. The reality, it turns out, is that it has not been a great few months for the US economy. So basically in Powell's speech, he stood up and said that. He said the labor market's slower. Now, if you've been watching, it's kind of obvious. So the most important news is that the most important macroeconomic policymaker said it out loud. But he's an honest man, so you kind of knew he'd say it out loud. And what's the right response? Well, right now, interest rates are a little bit above what the Fed calls neutral. So think about the Fed as having an accelerator and a brake. When interest rates are above neutral, it's stepping on the brake. When they're below neutral, it's stepping on the accelerator. We're actually currently got a little bit of a foot on the brake. And if you're worried that the economy is slowing and actually is not in a healthy place, then you probably don't want your foot on the brake anymore. So in the very short run, the direct implication is that the Fed has cleared the way to cut interest rates at the September meeting. That'll probably cut them by about a quarter of a percentage point, which is in fact, it's not tapping on the accelerator. It's taking its foot slightly off the brake. It's actually kind of uninteresting. A quarter of a percentage point here or there. Now, he sort of showed that he's willing to continue to do it through the rest of the year. But anyone who's been watching or knows this Fed sort of knows that when the economy slows, that's what they're going to do. So I think it's good news. We shouldn't have our foot on the brake right now. I have great trust in the Fed, so I'm unsurprised that that's the direction they're moving. So the only reason I think this is noteworthy is the extraordinary headlines it got. The story I'm telling is an unusual one and probably a terrible one for a podcast audience. Sorry, Jen. Which is the world is remarkably boring, but the headlines are incredibly exciting. Stocks rose by over a percentage point. I want to tell you why that puzzles me as an economist. Now, by the way, I'm not telling anyone the market got it right or wrong, or I know what's going to happen. I'm not an investment advisor and I'm not rich. But stocks, when you buy stock, you're buying the future profits of the company. Which is why when you take a finance course, they call it the net present value of future corporate earnings. Right? The full stream of the future profitability of all the American companies. Can you believe that went up by 1 percentage point? 1% normally sounds small, but we're talking about the next infinity years of earnings. Went up by 1%. Because interest rates might be a quarter of a percent lower for a few months a little bit earlier than some people feared. So I think the surprise here is what's surprising. Maybe markets are reacting to something deeper. I'm not sure. In terms of what it means for the audience, we've moved from a foot heavily on the brake to lightly on the brake. I think Powell suggested that they don't want their foot on the brake at all right now. So also central banks, the Fed, when it starts moving in one direction, doesn't like turning around. So it makes it more likely the future holds more rate cuts. Equally, Powell wasn't promising. When he wants to promise, he looks you in the eye and promises. He kind of said, I'm going to look at the data and see. My anticipation is that's where we're going. So if you've got a car loan that's or a floating mortgage rate, you expect rates to come down a bit over the next few months. But I think we don't really know what the future holds. If the future holds a recession, maybe we'll see them come all the way down. We'll see interest rates come down. But then that's a dose of bad news, a recession, with a dose of trying to help you out. And if inflation takes off, maybe this will be the last rate cut in a little while. We'll see.
One of the aspects of the tariff regime that we are living under now, which perhaps we didn't expect, at least for this length of time, is that retailers seem to be eating the costs. In other words, they're very hesitant about passing those costs on to consumers. Good news, then prices aren't going up. Perhaps then inflation's a little bit less of a concern. But they can't do this forever. They have to make money. And the old adage that they can't make up on volume what they lose on margin. How long can they do this? And what happens when they stop eating the cost and start passing it on?
Right. So first of all, I want to be clear. I'm not a Chamber of Commerce shill, and I'm not sitting here that Walmart's profitability has fallen a little. It's the tears that causes me at night are rather minor. Now, what I want to do is actually give you a framework, give your audience a framework for thinking about this. See, when you impose tariffs, there's essentially 4 things that could happen. If we impose tariffs, say, on washing machines, just my favorite example because we've got lots of evidence on this. First thing that could happen is that you make foreign washing machines so uncompetitive, they just stop sending them over. Actually, we saw a little bit of that. Remember, Trump raised tariffs on China all the way up to 135%? Basically, the ships stopped coming. Okay, then he realized that was too much and he reduced them because he's a very rational policymaker. So that's the first thing that could happen. Okay. Second thing that could happen, remember Trump promised us that foreigners would pay the tariffs. How does that work? So here, it's important to understand how tariffs work in practice. When Samsung sends a washer to the United States, it arrives on our shores and it sits in customs. Now, it sent the washer because Best Buy ordered it. So it's now sitting in customs. Best Buy ordered it. The only way Best Buy can get it out of customs and onto their trucks and into the store is by paying the tariff, say $100. So just to be clear here, the person who writes the check is not Samsung. It's Best Buy. And then Samsung takes that washer, puts it on the showroom. So there are three ways the tariffs could get paid. The first is, remember we promised foreigners would pay the tariff. The only way that would happen is if Samsung cut the price of their washer in order to maintain market share. And they cut it by enough that Best Buy wouldn't notice that it also has to pay the tariff. That's what we were promised. There's actually an index called the Import Price Index, which is the price at which we buy stuff from abroad. So tariffs right now are around about 10%. They're about to rise to about 18%. Actually, right now they're probably about 18%. When they announce it and when it goes into effect, there's some stuff there, right? So tariffs are about 18%. So therefore, the only way that foreigners could bear the cost of that would be if foreigners cut their prices by 18%. The import price index is the most boring straight line you've ever seen. Nothing happened. They didn't cut their prices. What we infer from that is foreigners aren't paying it, right? So therefore, we know that Best Buy paid customs, and Best Buy now has two choices. Do raise the price, and therefore customers pay. Don't raise the price, in which case Best Buy pays. So far, we've only seen a little bit of them raising price tags on consumers. How do we know that? Because we have a price index called the Consumer Price Index, which basically looks at the price of stuff at the grocery store, at Best Buy, and elsewhere. It's risen a little bit, and it's risen a little bit in areas where we expect tariffs to bite, appliances and so on. We don't expect tariffs to affect the price of haircuts. We do expect them to affect the price of washing machines. Furniture's gone up, but not overwhelmingly yet. Okay. So someone has to pay. It's not the foreigner. It's not the consumer. Must be Best Buy. Okay. So this is reduced profit margins for Best Buy. First point I want to make here is this is an American company. So the tariffs are being paid by Americans. Now you might say I don't care about Best Buy, but remember your 401k is invested in the US stock market, which means the reduced profitability of Best Buy is reduced retirement savings for you. A lot of people say, oh, the American stock market's owned by people in lots of countries. It's mostly owned by Americans. So if we make Best Buy less valuable, Americans are worth less. So it's still Americans. It's just not the price tag. It's your 401k. It's a little more invisible. We've actually seen this in lots of places. If you recall, about a month ago, we were getting headlines from earnings reports from Ford and General Motors, like $1 billion here or $1 billion there. Every company with their earnings report was like, we're losing billions or hundreds of millions due to tariffs. Walmart as well, actually. And so that explains what was going on. Now, you might feel okay if you're just someone who doesn't have many stocks. This is fine. Why is it that this has happened? And I think there's sort of two things to realize. The first is that companies don't like changing their prices very often. In fact, the general rule of thumb is change prices as rarely as you can. Even though it feels like they're changing a lot, companies' costs are going like this all the time, up and down, up and down, up and down. And what they try and do is keep a steady price when it's up and make it up for when their costs are down. And so generally prices take quite a while to respond. And so if you'd gone back and asked me, Jen, back in 2024 in the pre-tariff era, how long would it take for this to go through to consumer price? I would have said, hey, hold on, wait a while. It's going to take a bit. A few months, I don't mean a few years. Right? So I wouldn't be surprised if we haven't seen much yet. Here's the second thing. It's actually sort of clever. They announce the tariffs, and there's a whole hullabaloo. And then they back off the tariffs. And then they announce the tariffs. And then finally they impose them. So tariff headlines have been with us since the guy came to power, January 20. They probably peaked around about Liberation Day, April. And they were really huge through April, May and June. But actually most of the tariffs weren't in yet. Most of the tariffs only just went in August. We haven't even seen consumer price data for August.
Yes.
So when you look at the price, so what you've got is a separation of announcement and economic impact, which is going to make it harder for people to connect their reality with the policy announcement. And that's why people are like, why aren't prices going up with tariffs? They haven't imposed a lot of them. Then I want to add one more thing, which is there's some underlying economics here. Remember I said companies don't like to change their prices very often. If something temporarily raises their costs, they try to just, we'll wear it for now. And if it lowers their costs, we'll take that for now. Tariffs have been in flux the whole time. They've been a transitory shock. No one has been able to sit down with their pricing team and say, hey, how should we respond to these tariffs? Because if they had the meeting on Monday, there'd be a different set of tariffs on Tuesday, and they'd have to redo their homework on Wednesday, and then set the prices on Thursday, and then redo it again on Friday. It's now clear tariffs are a permanent shock, and we know which countries are getting them, and where, and which goods. Now it's time for companies to sit down and do their repricing. And so this is, I think, the other explanation. They were a temporary, unclear, incoherent, on one day, off the next shock before. Now they're here. And I can guarantee you every pricing team around the country is sitting down and saying, how should we react? Some of them are going to try and hold the line for a little while, but simple rule of thumb is if a company's costs go up, so do its prices. This isn't going to be any different. And so I think basically between now and Christmas, we're going to start to see things happen. But remember, those data aren't going to come out until a few weeks or months after that. And so we're going to see it in the numbers a month or two after we're going to see it in our lives. And you're probably going to start to see it in your lives. A little bit, you're already seeing it now, but you're going to see it a whole lot more.
Now, one of the other phenomenon we're seeing, and I wonder if it's related to exactly what you've just been talking about, is that the labor market isn't falling off a cliff, but people aren't doing a lot of hiring. Is that because people are looking around and saying, I don't know what the business market is going to be. I don't know if we're going to be selling washers or not. Let's just not hire people. We don't necessarily want to lose people, but if they retire or they quit, that's fine. But we're not going to go on a hiring spree. Is that kind of what's happening and why the labor market is kind of slowing to a halt?
So, Jen, one of the hardest things I think for any of us, I just want to give a preamble, sorry. I think one of the hardest things for any of us in the present moment is maintaining a sense of objectivity. That, I got to tell you, I don't really like the president, so when he does things, I tend to blame him, and I always want to come back and double check, hey, is that right? And so it'd be easy for me to look at the current slowing in the labour market and say, boy, this is all Trump. But I don't want to. I want to show your audience that I've got the metacognition. That was my first reaction. But I went back and I thought harder about it. And I think that's important. I think it's important we all do it. So really, I want to give some context, which is probably last time we spoke. The puzzle was, why do the data look so good when the policy is so bad, the headlines are so bad, and surveys of how people feel are so bad? So we had the data up here and everything else felt like it was down here. What happened is the data came back. So basically a puzzle went away. Okay, so we previously, if I were in the Trump press office, I would have been saying, but hard numbers are so strong, you people are wrong. Now that argument went away. Now, think we're not in a recession, but things are distinctly moderate, possibly mediocre. So the sense you're getting from surveys of CEOs, surveys of consumers, from your life, from the headlines that we're not in a great economy, actually turns out it was true and true all along, but it's taken the data a little while to speak clearly. Now, here's a real puzzle. Again, we can go back to a car. We can think about the economy has a long-run potential growth rate, might be 2%. And there's a little bit of Goldilocks. You don't want to go too hot. You don't want to go too cold. You want your porridge to be just right, the same way you want your economy to be growing just right. The question right now is, normally, if the economy was creating 60, 70,000 jobs a month, we'd say, boy, that's a little too cold, that porridge. The economy's not doing well, unemployment's going to rise. Right? The problem is we don't know what neutral is. We don't know what the economy's potential growth rate is. Now, we never know, but we know something is going on right now, which is a big crackdown on immigration. And a simple rule of thumb is when you have more people make more stuff. And so the economy's potential growth rate is higher. Another way to think about this is how many jobs do we need to create each month in order to keep the unemployment rate from either rising or falling? We sometimes call that the break-even number. And so that back when you and I started watching the economy might have been 150,000 jobs a month. We don't actually know what it is. It's actually possible it's as low as 50,000, in which case jobs growth of 60,000 is perfectly okay. It also might be as high as, let's say 100,000, in which case jobs growth of 60,000 is pretty bad. So what we have at the moment is a supply shock. We have fewer workers, and so the economy is growing to grow less in aggregate terms, but even if it were going to grow at the same rate per person, what we care about is growth per person, right? How much is each person's slice of pie growing? So if the economy grew slower just because we were adding fewer Americans, that's okay for yours and my living standards. And so we know that the economy as a whole is not growing as quick. What we don't know is whether that means that our slices are getting smaller or that pie is getting shared across fewer people and our slices are still growing pretty well. So very hard to know right now. What I also do know, though, is that we're at a point where if the economy is growing great, here's terrible, and there's a shock comes along, great takes you down to moderate. That's the safety buffer. If we're starting at moderate and a shock comes along, doesn't take much to get you to terrible. That's true right now. So we're one bad shock away from a recession. And a question is, has that shock occurred? Is it tariffs? Is it incompetence? Is it an immigration shock? Is it a competence shock? Is it business packs up its bat and ball and goes away? Is it decreasing integration with the rest of the world? Or is this the little engine that could, the great American economy that is often resistant to shocks and keeps on keeping on?
Now, I want to talk to you about an outbreak scourge of communism in the United States. It seems that this left-wing president has decided to take shares in companies. This sounds like Bernie Sanders has undertaken a coup. What is this about the United States government taking a share in Intel, which last time I looked was sort of, I don't want to say dying, but a listing company. What the heck is going on? I thought we were a semi-free market, and now the government is taking a stake in businesses. What's going on?
Well, Jen. What a rich vein there is. Hey, can I start with Intel? And when I forget the second half, bring me back to your question about the broader sense of government intervention, because
Yes.
it's interesting on its own. So first of all, it's the most bizarre story I've ever seen.
Yeah.
In the beginning of August, so Intel's an American chip company. In the beginning of August, Trump wakes up one morning and posts on Truth Social that Intel must fire its CEO. Literally wants to fire the guy. He doesn't get to fire the guy because he's the president of the United States, not of Intel, but he more or less says to Intel, you better do this. A couple of weeks later, the CEO of Intel goes to the White House for a meeting. I don't know what happens in there. But a week after that, Trump praises the guy as the extremely sophisticated businessman and says the United States government's going to take a 10% stake in Intel, which means we just took a 10% stake in a company run by a man 3 weeks earlier he thought should be fired. And the guy's still running it. I don't tend to invest in companies run by imbeciles, by conflicted people, by lunatics, by incompetent people. I just don't. I like to buy stock in companies that are well run. So this guy's had a hell of a turnaround. I mean, he's gone from being someone you should fire to someone you should invest in. And as far as I can tell, the only thing that happened in between was he visited the White House. That might sound like I'm making a conspiratorial hint, and I'm really not. I'm actually just baffled. Like, what happened? Okay. Does the US government buying stock in Intel fix anything? Right? So we've had government involvement in private corporations before. The Obama administration got deeply involved in the auto sector during the 2008 financial crisis. We hear about bailouts every time there's a financial crisis. Is this just part of that? Actually, this is kind of unusual. So the question that I want to ask, what problem is this the solution? To understand how puzzling this is, you need to understand what it is the US government just did. We bought stock in Intel. What does that change about the world? Does it change the CEO? No. Does it change their corporate strategy? No. Does it change the access that they get to foreign markets? No. Does it change who the US government will buy chips from? Apparently the answer is no. Does it change what they're doing, how they're innovating? Nothing. The only thing that happens is there's a whole bunch of stock certificates in someone's safe. They open the safe and they take the stock certificates out and they put them in the US government's safe. The physical location of a bunch of stock certificates just changed. How does that help Intel? How does that help the American people? So I want to come back to what problem is transferring the location and physical ownership of stock certificates solve? I literally can't think of one. So maybe they're doing something else. Well, if the US government now owns the stock certificates, maybe the US government could help Intel, run it a little better, tell it what to do. Actually, the Treasury Secretary said they're not going to play any role in governance whatsoever. That's actually a bad thing. When there's a concentrated owner of a company, one of the things they do is they look over the board's shoulder and make sure the board's doing a good job. But actually, Scott Bessent said, no, we're going to just stare out the window and not care. Well, maybe now the government is a co-owner of Intel. Maybe it'll pressure American companies to buy Intel rather than other chips. Well, they've said they're not going to do that. Then what are they going to do? Now, by the way, do you believe them? Is there any part of American business they haven't felt the desire to interfere in? They tell Coke to put sugar rather than corn syrup in their recipe. Honestly, I don't believe them. But their claim is that they're not going to play any role in governance. So their claim literally is they're moving the stock certificates. You might say, are they going to get more money, Intel? No, I mean, it's just the value of the company hasn't changed. The value of the company is the net present value of its future profits. It always had the ability to issue more stock and get more money from the market if the market wanted to buy it. Oh, wait. Maybe we just bought their stock because the market wouldn't. Why wouldn't the market want to buy stock in Intel? Maybe they think it's not very profitable. Maybe we got stuck with the stock certificates no one else wants. Geez, if that was my stock picker, I'd be pissed off at my stockbroker if he walked around buying stocks that no one else wanted to buy. And he's doing it with my money. Okay, so that's Intel, right? So I just wanted to zero in on Intel because it's a particular and peculiar thing. It's also, by the way, unclear if we paid for the stocks,
Yes,
or we just demanded them. The latter seems like we're nationalizing a company. Now, by the way, you might say, well, Obama did it with the auto companies in '08. Well, they were about to go bust. They were about to go bust because the country was tanking. So was the global
yes.
economy. Jen, what is the most exciting sector of the economy right now? Chips and AI. It's the opposite of a bust. NVIDIA is the world's most valuable company. If you can't make money selling chips in the AI moment, I don't know when you're going to. So I don't like so maybe this is, the only other rationale I've got is maybe you buy stock in a company because you and you alone understand that it's undervalued. You know, if the market understood it, the market would correct it. So then this would be a view that the president is our stock picker in chief. Honestly, these guys took 6 months to or 10 years to finally decide on a tariff agenda. They're the Keystone Cops. They can't do one thing right in a row. The idea that they are making sophisticated stock bets on yours and my behalf is absurd. So I really am just puzzled. I think there is a tradition, strongmen all around the world, in very small countries, will insist on having their own currency, their own airline, and so these national champions, right? Why should Fiji have its own airline? By the way, Fiji Airlines is very good, but small countries often do this. Now, these big money-losing things, but that's because there's a sense of national pride around it. Maybe that's what's going on, but I would like to think that the economics of the United States is different than the economics of Fiji. I might be wrong. Okay.
By the way, your comment about losing money in this kind of environment kind of reminds me of someone who would lose money running a casino. It seems almost impossible. It takes skill to be that bad. But it does open the possibility that the stock will continue to go down, and this bizarre, baffling move will cost all of the taxpayers money. There's no guarantee, of course, they stabilize or they improve. We could get stuck with a sinking company, and what do we do then? We buy more of the stock, more of the losing stock? It seems not a good move. Puzzling.
I think it could go either way. I don't want to say it's definitely going to go down or definitely going to go up. I was just like, I'd already balanced my portfolio. I didn't need some other bloke deciding to unbalance my portfolio by going on Intel with my money. I'd already figured it out.
Yeah. Yeah. Well, we have to have faith because they've been so rational, so successful in the past. There must be a hidden genius that the mere mortals like us can't divine, but we will try. Thank you, as always, Justin, for not only explaining things, but reassuring us that some things are just inexplicable or just dumb, which we need to hear every once in a while. So thank you so much. We'll look forward to seeing you next time.
Great pleasure.
Take care. Bye-bye.